All right, looks like we are a little after 10 o'clock. First off, let me just welcome everybody to our 2025 retirement plan regulatory update. My name is David Williams, and I'm joined by Greg Johnson. Today, we're going to walk you through a couple of slides here, kind of covering some of the items that we've laid out in our longer form report. Again, my name is David Williams. I'm a consultant. I also chair our investment committee here at Multnomah Group. And today I'm joined by Greg Johnson. Greg, you want to introduce yourself?
Yeah, thanks, David. Greg Johnson, senior consultant here at Multnomah Group. Also, I'm the director of our ERISA Technical Services Committee, which means I oversee a lot of the information and prepare a lot of the information that we'll go over today in the regulatory update.
Great. Thanks, Greg. Just a couple of quick housekeeping items. This session is being recorded. We'll send a link out to everyone who signed up for the webinar in the next day or so. We also have a couple of ways for you to interact with us through I think there's a Q&A function as well as a chat function that Greg and I will be monitoring as we go through this. This particular slide, just a little bit of background on Multnomah Group. If you're not familiar with who we are a retirement plan consulting firm focused on defined contribution plans and consulting to plan sponsors across the kind of spectrum of corporate, not-for-profit, and governmental plan sponsors. We're currently, I guess, as of June 30th, sitting right around 185 clients and about 46 billion in assets under advisement. So with that background on Greg and myself and our firm, again, thank you for joining us today, and I'll turn it over to Greg to get us started.
All right. Thanks, David. Yeah, we're following sort of a typical format, which is we go over any significant legislative action, look at sort of what the IRS and Department of Labor has been doing recently, and then go over some of the lessons that we can learn from recent litigation. We're going to close today with sort of an update on some of the different types of investment products that we're seeing sort of introduced in the defined contribution space for possible use in a retirement plan. But starting with the legislative update, the Secure and Secure 2.0 were really the most substantive retirement plan legislation in probably over 10 years and probably continue to dominate a lot of the work, especially as we continue to get guidance on some of the optional and mandatory provisions that are continuing to go into effect. So really, since those two were passed, we haven't seen a ton of legislative activity relative to retirement plans, defined contribution retirement plans in particular, which isn't unexpected, but it is certainly one area where we do have, generally speaking, some degree of bipartisan support. So it is an area that if the government were functioning or running, that would be an area that they could actually get some things done. But there are a couple bills out there that have been introduced. Both of them have been introduced in prior sessions. The first is Helping Young Americans Save for Retirement Act. This would reduce the minimum age for participation in a defined contribution plan from 18 to 21. I think the thought there is that getting individuals started earlier with good savings habits and the use of auto enroll and auto increase and things like that would have a long-term significant benefit for these individuals if they're participating earlier. The other one is one that we've talked about quite a bit, the Retirement Fairness for Charities and Educational Institutions Act. This has continued to come up. Just as a reminder, this is the bill that would allow collective investment trusts to be available in 403(b) plans. So the Secure Act provided for the use of CITs and 403(b) plans, but the problem is the Secure Act did not amend the securities laws to allow for CITs. This is one that I do think it's not a matter of if, but when. Whether or not it will get through this year, though, I'd say given the current environment, the odds are probably going down. If it does pass, probably the only way it's going to get through is if it's attached to another spending bill or something towards the end of the year. The other legislation, the One Big Beautiful Bill Act, really didn't contain any substantive retirement plan provisions. From my standpoint, that's probably good though, because I think one area that we thought there could be some impact is sort of the ongoing, what we'll call Rothification of retirement plan taxation. In other words, sort of forcing contributions to be put in on an after-tax basis rather than a pre-tax basis. So that was not included. Moving on to the Internal Revenue Service, again, a lot of what the IRS is doing is focusing on some of the mandatory provisions. And the first one we'll start out with is secure. There's the section 603, which is the one that requires catch-up contributions for individuals what's considered in this bill or in this rule, high-earning individuals making over $145,000 in FICA wages from the previous year. If they want to put in after-tax, or if they want to put in catch-up contributions, they do have to be moved to after-tax Roth type contributions. Now, technically, this rule went into effect 1/1/24, but this has been one of the most problematic rules in the Secure Act because of the administrative complexity around it. There are a lot of plans that didn't even offer Roth, so you needed to add that to the plan. Uncertainty about how you turn it on and off, how you flip it over to after-tax Roth contributions once that individual reaches their 402(g) limit. So there were definitely so no one was really prepared to operate it properly as of 1/1/24. We did just get recent guidance, final guidance relative to Section 603. It was interesting in the guidance, it said that the final rules are effective 1/1/27. And some people thought, oh, well, that means that they kicked the can down the road again on this. So I don't have to start doing it until 2027. That is not the case. We do believe that it does need to be followed 1/1/26 if you are administratively capable of doing it. So if your record keeper is capable of helping you or payroll provider is capable of helping you monitor and implement this, you do need to implement it effective 1/1/26. Generally speaking, I do think plan sponsors, record keepers, payroll providers seem prepared. So I think if all the operations are in place, you should start doing it 1/1/26. David, are you seeing similar things?
Yeah, where I have a few clients that are doing payroll in-house. That's been an area maybe of a bit more struggle as the record keepers are largely pushing this to the payroll providers. And payroll providers, have been working diligently over the last, year or so to get this in place. Where we have seen a little bit of struggle is if you're doing payroll in-house and making sure that you get resources allocated, whether it be from outside of HR or finance from a tech standpoint to do the necessary coding to be ready to run this. I do think most are ready to run. I think it's not generally speaking an issue for January 1, unless you have kind of some of those super contributors that are looking to kind of front load their uh, those contributions in early 2026. But I would say generally speaking, yeah, people are ready to roll with that one complication if you're doing payroll in-house.
Yeah, and you're right. The super front loaders could cause a problem, but if you don't really have anyone trying to max out early in the year, you don't have to necessarily be administratively ready to operationalize this until someone first hits their 402(g) limit. We do have a question in the chat here. So if your plan allows for catch up, but you don't have Roth, do you have to add Roth before 1/1/2026? The answer is no, you don't have to add Roth, but the challenge there is any of your high earning participants that have an interest in continuing to put catch up contributions would no longer be able to. So once they hit their 402(g) limit, they would have to stop contributing to the plan. So that is one area that plans that didn't offer Roth have generally been trying to get it in before the 1/1/2026. So again, a lot of work on Section 603. It's probably been the most focused upon uh, part of Secure 2.0, but we are getting close to the time that it needs to be implemented. Another catch-up provision is called the super catch-up provision for individuals aged 60 to 63. This allows individuals during that period, just when they're 60 to 63, to make an additional super catch-up to their plan. In 2025, the super catch-up limit was 11,250. It's projected to move to $12,000 in 2026. The guidance here actually was pretty important, and it was pretty simple, though. It just stated that this is an optional provision. Um, a lot of people thought if you offer the age 50 catch up in your plan, you automatically have to offer the age 60 to 63 super catch up, which was concerning to some plan sponsors. Most of the plan sponsors I've talked to, they're comfortable that they can turn it on properly to allow people to put in the 11,250 or in 2026 the 12,000. They weren't as confident that once the individual turns 64, that they would be in an administrative position to turn it off. So there were some plan sponsors that looked at this and said, well, I'm not sure I want to offer it until I'm 100% sure that I can monitor it properly. So I think the guidance indicating that this is optional was very positive for some of those plan sponsors that were unsure of how they were going to administer this provision. Another big part of Secure 2.0 is a lot of, excuse me, a lot of these optional provisions. And I might let David sort of talk about what we're seeing from plan sponsors relative to some of these.
Great. Thanks, Greg. Yeah, so Secure 2.0 was kind of this grab bag of required and optional provisions and spread over kind of a 3 to 5 year implementation period. And that got extended because of some of the complexities of some of those provisions Greg just referred to earlier. And so, as we have been talking about this now, I think this is our third regulatory update with discussions of Secure 2.0. We've talked a lot with clients about some of these optional provisions, and we've seen, kind of some, I guess, consensus on interest in some of those optional provisions emerge over the last couple of years. And so, these three main bullets here kind of fall into those couple different buckets. That first one, we've seen many plan sponsors that offer involuntary cash outs, or sometimes referred to as small sum force outs. That's for participants that have terminated within a balance less than either the 5,000 or now the $7,000 figure. That allows you to force them out of the plan to either an IRA, typically to an IRA. The Secure gave an option to increase that from $5,000 to $7,000. I'd say broadly, anybody that was offering in that provision did increase that maximum from $5,000 to $7,000. The next bucket, there's a series of kind of life events or specific events that may occur to employees or participants that would allow them to take a penalty-free withdrawal, not tax-free withdrawal, but a penalty-free withdrawal from the retirement plan based on the kind of the sub bullets there of if you were involved in an area that had a federal disaster, you've got a terminal illness, you were a victim of domestic abuse, or there was an emergency withdrawal provision that you needed to take advantage of. And so this has been one of those more philosophical areas we've discussed with plan sponsors. Is the retirement plan there for meeting immediate needs, or is it there for saving for retirement? So whether you think of it as a paternalistic view, some plan sponsors have been a little reluctant to kind of open the retirement plan for meeting those immediate needs. And so I don't think that we've seen a consensus on whether or not to offer all or any of those provisions. And then the last bucket, um, you know, there's a couple of, I guess, more administratively complex provisions to to administer or to offer to participants, whether that's this emergency sidecar accounts, which is essentially a separate bucket for emergency needs that gets filled first, or matching of student loan repayments. So the idea that employee comes to an organization and is saddled with a sufficient student loan debt that they need to repay, that they're not able to then also save for retirement. So this allows the plan sponsor to make matching contributions based on those student loan repayments. And then I think Greg used it already, but the ratification of retirement plans, the ability to essentially turn your employer, whether it's matching or other employer contributions, into characterize them from a Roth standpoint, so that those are able to be withdrawn tax, grow and be withdrawn tax free. These all three provisions, I think, were of interest to many of our plan sponsors. Particularly, if you are working that second bullet, if you're working in an industry where maybe it's healthcare, where your employees generally come to you with a large amount of debt out of school, or there are other areas there as well. But I think there was of interest. The question is how to administer those in a cost-effective manner. Is that something that the employer is taking on? Is that something the record keeper is taking on, or is that a third party that's ultimately going to be managing that particular provision, and the costs associated with that, I think, have caused many of our plan sponsors to kind of take a bit more of a wait and see approach to that. I don't know, Greg, if you're seeing anything different as you're talking to some of your clients in with those particular
No, I
provisions.
think you're spot on. I mean, it's not, it's not necessarily that they're opposed to these provisions. I think it's just that they're not completely clear. There's other aspects that they've been focused on first. I think your comments about sort of different plan sponsors having different philosophical views relative to the optional provisions is pretty accurate as well. I have seen a few clients. So the emergency withdrawal one allows you to take up to $1,000. Most of these others, well, the others allow you to take significantly more out, penalty free. I have had at least one plan sponsor who said, well, why don't we turn on the emergency withdrawals and sort of monitor how it's being used? And if it appears that a lot of our participants need increased access, then we can talk about whether we want to do those things. I think one of the concerns that some plan sponsors, and certainly I share as well, because I do believe that ultimately, the purpose of a retirement plan is hopefully to help people have a successful retirement. Most of these do involve self-certification. So if you turn them on, for the most part, the only thing your participant has to say is, this situation applies to me, give me access to my money. That has been something I was very concerned about, especially as we went into COVID, when essentially we opened up the entire American retirement system. At that time, you could pretty much raise your hand and just take money out. I was legitimately concerned about the impact on retirement savings. I was pleasantly surprised to see that not many people took money out. In fact, COVID was such a unique time that a lot of people didn't have any way to spend money. And so we did see actually an increase in some people's savings, despite having the opportunity to have pretty open access. So while I still have concerns about self-certification and just free access to your retirement savings, it might not be as big of a concern as I sometimes think it is.
I think the one thing that I've seen, and maybe you have as well with clients, is I think as you kind of walk through some of those initial provisions, I think there's a philosophical discussion of, yes, the retirement plan is for retirement savings, but I think it's important that committees discuss that, or the settler discusses, are we going to say yes or no to this before the first time a participant comes to them with, hey, I've experienced X, Y, or Z that falls into one of these categories. I've, done some Google searching and I see that this is something that should be available to me. Why is this not available to my particular situation? I think that puts committees potentially in a rather tough or organizations in a rather tough spot if they haven't thought through from a principled standpoint why or why not we're going to offer these provisions to our employees. Something to, I think about from an organizational standpoint to keep your HR people, give them some cover from some of those questions.
Yeah, and I think at the same time, it sort of begs the question on those optional provisions. Why would you offer one over the other? You know,
Right.
why is one person's sort of situation more lenient to allow access and not someone else's who maybe falls under a different exception? So I can't say for sure, but my sense is once a committee goes down the path of flipping one of these on, maybe other than the emergency savings, but once you flip any of those other ones on that apply to a specific life situation, my guess is in relatively short order, you're just going to go ahead and turn all of them on would be my expectation. All right, so really, from a legislative and IRS standpoint, there hasn't been a ton of activity. The Department of Labor, as is becoming customary, has been a little more active, especially with the change of administration. So the first point here is industry veteran Daniel Aronowitz has been confirmed to head the Employee Benefit Security Administration. For those of you who might not be aware, the EBSA is a division of the Department of Labor that is responsible for enforcing ERISA. I think this is probably going to be a positive development for plan sponsors. Mr. Aronowitz has pledged to end regulation by litigation. It's not clear exactly how he's going to achieve that because he can't really prevent people from bringing lawsuits, but it'll be interesting to sort of keep an eye on what's happening there. And I think there is no question that he will be very supportive of initiatives that are aligned with less regulation rather than more. And the other area that we're going to talk about a little bit later is some of the different investment types of products, alternatives in particular. It is probably expected that he will be supportive of any activity in that area to increase access. So again, with the change in the administration, there have been two Department of Labor rules that have been basically ping pong back and forth depending on who's in control of the White House. And the DOL has already indicated their expectation that they will change or eliminate two rules. The first is the fiduciary rule. Historically, I guess the biggest change of the fiduciary rule was its impact on the definition of a fiduciary to include one-time transactions like an IRA rollover. So if you're talking to an investment advisor and they say, well, why don't you cash out of your retirement plan and we're going to move it over to this IRA, that would have been considered a fiduciary decision. The rule was already facing pretty significant legal challenges. The industry sued the Department of Labor, challenging the rule, saying that it was essentially the same rule that had been overturned by the Supreme Court earlier, and also claiming that there are sufficient protections in place for the consumer so that this was not necessary. In September, the rule was supposed to go into effect September of 2024, and the judge in that case actually issued a ruling that prevented the rule from taking effect. And in his opinion, he stated that the reason that he was going to put a stay on the effectiveness of the rule was due to a strong likelihood that the plaintiffs will be successful in their lawsuits. So the DOL has appealed or has continued to argue that case. But with the new administration, they have made now 3 requests to pause the litigation while they review the rule. I think ultimately they will probably stop pursuing that. The other rule that is certainly going to be replaced or at least changed is the ESG rule, which we've talked about quite a bit. Environmental, social, and governance investing. The Biden era rule actually withstood legal challenges in court. A judge in North Texas actually ruled in favor of the rule, indicating that it didn't require the use of social factors and other ideas, so that it was appropriate. That was a bit of a surprise decision. The attorney generals that brought the lawsuit, though, had appealed it. And very similar to the fiduciary rule, the DOL has requested a pause in that litigation. Since then, on September 24th, the DOL announced its intent to replace both of these rules. Another area of Department of Labor action is relative to cryptocurrency investments. So, in 2022, the Department of Labor issued some general guidance that sort of advised plan sponsors to take extreme care if they're going to offer cryptocurrency in their retirement plan. I would say the guidance wasn't perfect for a couple reasons. It wasn't really a rule, but it sort of felt like, hey, you're sort of making an administrative rule here, but you're not following the proper procedures. So there were some questions about what exactly does this mean? Even more concerning, it did suggest that if we come audit your plan and we see cryptocurrency investments available to participants, we're probably going to stick around a little longer than if we don't see it. One very concerning to me aspect of this too was that there was one sentence that sort of suggested even if it's in your self-directed brokerage account, we still might take a further look. And this was not good news because traditionally the self-directed brokerage account is not part of the plan sponsor's fiduciary oversight. The DOL did walk that back a little bit, so they sort of stepped away from that. But in May of 2025, the current DOL rescinded the guidance completely. In their words, they would like to have a more neutral approach relative to cryptocurrency. In reality, I think we're going to see an administration that probably supports the use of cryptocurrency in defined contribution plans. But if you take them at face value, their removal of the guidance was just to sort of state that they have sort of no opinion on it. David, as the head of our investment committee, what are your thoughts on cryptocurrency and defined contribution plans?
I mean, I think at the end of the day, it's whether it's cryptocurrency or any other investment, our view is that, if a committee is going to offer that and, a particular investment to their employees and to their participants through the retirement plan, they've got an obligation to understand kind of the fundamentals of that investment, uh, be confident they can communicate the benefits and the risks of that investment to their employees, and that their employees are able to decipher whether or not that's an appropriate investment for them as part of a diversified portfolio. So, I'm not looking to make a statement on the validity of cryptocurrency versus any other investment in particular, other than to say, I think some of the characteristics of cryptocurrency are that it's a single I guess a single security type of investment that comes historically has come with some very positive upside potential, but also with some volatility associated with it that's more than the traditional diversified investment options offered to employees. So I think it's not that there's caution or extreme care or whatever word choice there, but the idea is you better understand the investment and be able to communicate kind of the benefits and risks of that investment to participants. I mean, there certainly are there's been some innovation from a record keeping standpoint to bring cryptocurrency to the defined contribution market, and I expect that, as you said, the current administration is a bit more supportive of those types of investments. We see that, and we'll talk a little bit more about it as we go through this, but some alternative investments. And so I think we need to be aware of kind of where the kind of the regulatory tide is shifting, and then that committees really spend some time understanding kind of those benefits and risks of these traditionally not offered investment options in defined contribution plans to determine are they appropriate for their employee mix, participant mix. So I think there's more to come as we go through the next year or so.
Yeah, I mean, I think currently, again, the fiduciary protection in the self-directed brokerage account, I think most plan sponsors who are even talking about this are probably saying, hey, if someone can find it through a self-directed brokerage account and wants to invest in it, that's fine. that might be an appropriate investment for that one individual. That doesn't mean that we should put it on our platform and make it available to all of our participants as a monitored investment option through the plan. I think that's where we're at today. But sort of what David said, we'll see where things go going forward.
I mean, the idea, I think you're seeing it, and you probably in client discussions as well. There's not a great appetite for single asset class, whether it's, company stock or gold or technology sector or those types of, historically high volatility assets. I think there's a lot of caution being expressed by the committees that we work with.
Yeah, for sure. So the final area of activity in the Department of Labor is a brief that was filed in one of the use of forfeiture cases in favor of the defendant Hewlett Packard. And before I go over sort of what that said, let's talk a real bit in the first part of the litigation update about the use of forfeiture litigation. This is probably one of the biggest areas of litigation activity that we've seen. There have been over 60 lawsuits filed since 2023. At least 16 of these have been dismissed, which I think they all should be, to be honest with you. But there is one that I noted here, the Bank of America case, where there was a denial of a motion to dismiss, rejecting the argument that the decision on how to use forfeitures is a settler decision. So let's back up a little bit and talk a little bit about what these cases are. Essentially, when you have forfeitures sitting in your plan, the most common way that you're going to get a whole bunch of forfeitures is to have a vesting schedule. And then when people leave employment before they're fully vested, that is a forfeiture, and that goes into account. So very large plans with fairly aggressive vesting schedules are probably the most likely to be targeted for this type of litigation. And the issue is, how are you using those forfeitures? Are you using them to reduce future employer contributions, which is deemed that's probably in the best interest of the employer, right? Or should you be using them to reduce plan costs, or even returning that money back to plan participants? And essentially what the plaintiffs are saying in these cases is, it really doesn't matter if you're allowed to reduce employer contributions. It's a fiduciary decision. And as a fiduciary, you've got these options in front of you, and you picked the one that's best for the employer, but there's other ones that are best for me, the participant. You should be picking those. The defendants in these cases say, no, that's not a fiduciary decision. That's a settler decision that I can make as the plan sponsor. And so therefore I can do whatever I want with them. I do think over time, we will probably see a lot of plans sort of tighten up maybe the rules around use of forfeitures in their documents. A lot of plan documents just sort of indicate these optional ways of using them. So you might see that tighten up a little bit. But generally speaking, I've been opposed to these cases because they are challenging something that is absolutely allowed, which is using plan forfeitures to reduce employer contributions. I mentioned earlier that there's the DOL plans to reduce regulation by litigation. And this is one way that I think they're trying to support that initiative by filing a brief in favor of Hewlett Packard. Basically, what it says is HP's use of forfeitures is a long established and very much permitted practice that's been in place for decades. The use of forfeiture decision in the DOL's opinion is a settler decision, not a fiduciary decision. And also, the plan sponsor is solely responsible for setting and funding a plan's contributions. So again, that is a plan sponsor decision, and therefore a settler decision. I do think this is a step in the right direction, especially relative to the forfeiture cases. I do want to see more and more of them be reduced, because one of the other arguments that I've heard is, under the rules of the plan document, a participant is not entitled to the forfeitures. You can use them to give them to participants, but the contribution rate that the employer has put in place, assuming the employer is giving them their full contribution, participants are receiving everything they are entitled to under the plan when they get the stated employer contribution. They are not entitled to anything beyond that. Again, the last bullet point here: points out this only applies to the Hewlett-Packard case, but I think it is hoped that courts deciding similar cases will look to it for some guidance as we do see the DOL try and reduce some of this litigation. So moving on into the litigation update, unfortunately, there's still plenty of litigation to pick from when I do this section. For the most part, what I'm trying to do here is pick cases that help sort of tell a story or help us as plan sponsors understand what our responsibilities are. So the first one is a Supreme Court case, Cunningham versus Cornell University. This was a unanimous Supreme Court ruling in favor of the plaintiffs, and it sets sort of the pleading standards for what a plaintiff has to claim for an ERISA prohibited transaction. There's sort of a split in the lower courts. Some of them were saying you can just say there's a prohibited transaction and an injury, and then you can move forward with the case. Others were saying not only do you have to say that there's a prohibited transaction, show that there was an injury, but you also have to claim that no exemption applies to the prohibited transaction rule. There is no question, I don't think, that this will make it easier for litigation to proceed through the pleading stage. Had the decision gone the other way, it would have been more difficult. While I do think it could result in an increase in litigation, to some degree, I do understand the ruling. I sort of get it that at the pleading stage, the plaintiff might not have enough information to claim definitively that no exemption to their prohibited transaction exists. And we've already seen one case, Collins versus Northeast Grocery, excuse me, was returned to the lower court. The original ruling found in favor of the defendants on the basis that based on the Supreme Court ruling, it was sent back down for further review. So not only new cases, but even some existing cases we may find get new life as a result of this decision. Oops. The next one is an interesting one against Empower Advisory Group. So this is a case where the plan, typically what we see is the plan sponsor being sued and the record keeper not being part of the litigation. This one's a little different because it does actually target Empower. And in this case, recently filed. So again, it's just been filed August 2025. Plaintiffs allege that Empower sort of mined the participant data that they had, identified some of the high balance participants, and then shared those names with their investment advisory group. The investment advisory group then allegedly solicited participants to encourage them to roll assets out of the employer's plan and into a managed account product that Empower has. So a little different than what some plan sponsors have. Some of you may have managed accounts inside of your plan that you offer to participants. They were actually taking the money out of the retirement plan and putting it into a separate Empower product. The case goes on to allege that representatives failed to disclose the higher fees without really displaying any measurable or future measurable increase in returns, and also failed to disclose their compensation structure, which included financial incentives for selling these products. And again, these are all allegations. You can see at the bottom, Empower believes the case is without merit and will defend itself vigorously. So what does this mean to you if you're a plan sponsor? I think there is a little piece of this case that suggests that the plan sponsor, the employer, does have a duty to monitor the record keeper's sales practices and how they're using participant data more closely. And David and I were talking about this when we were getting ready. This is sort of a tough one, right? Because to understand how your record keeper is using your participant data, the only person who fully knows is your record keeper. But I would encourage you, at least on an annual basis, if you are having sort of an administrative update from your record keeper, that you do encourage them to share what their practices are relative to the use of participant data, because it's definitely an area where you're sending an awful lot of personal information on a regular basis to your record keeper. And if they are using it in a way to sell products that you are not aware of, I do think it's something that you at least need to make an attempt to be aware of. All right, David, did you have anything to add to that piece?
Other than to say, I think this is tricky, and it does highlight the you know. There's explicit fees that record keepers charge, but there's also other motivations that they have for record keeping your plan. And so it requires an engaged discussion about the business practices specific to that record keeper. And I do think, Greg, your point of the way, and I think you'll talk about this in a little bit, but the way committees stay in front of this is by having good discussions, documenting those discussions, and monitoring the practices of their service providers. And so I think it's this really highlights the need to continue to ask probing questions around different practices that record keepers and other service providers have as a result of information that they garner from your plan participants.
Yeah, and I think I mean, you're right. It's tricky too because if you think about who some of the largest record keepers are, they are very large financial services firms that in many cases offer additional products and services that may be very, very beneficial and very needed by your plan participants. So, a world where we restrict a record keeper from talking at all about their other products and services, I don't think that's where we want to be either, because there are people that need additional help with their financial planning beyond just their retirement plan, and these companies are in a position to help them with that.
And I think I don't know about you, but I've been in many committee conversations that essentially come back to financial wellness is important. It's an important concept, and our participants have real needs, and we want them to be able to solve those issues so that they can focus on work and life and other priorities that they might have. So it's the challenge is some people view every nail as something that needs to be hammered, every problem that needs to be solved, and there are probably some good solutions and some rationale for participants to receive holistic advice from the defined contribution plan provider. And it's really just a question, I think, of then the committee putting the hat on and saying, not everything's wrong or bad. There are benefits to having these services come from our provider. The question is, we need to understand kind of the motivations and that our service provider has, and what services that are being offered to our participants. I'm also reminded I've had a conversation with a plan sponsor a couple of years ago. It said, "Hey, our record keeper offers a holistic set of financial wellness tools, but our EAP offering also has similar. So the question is, what's the best set of tools available? Should it come from the 401k record keeper? Should it come from the EAP? Should it come from something else?" And so it's really, from my perspective, that plan sponsor kind of having a checklist and walking through what's the best offering, and making sure they're aware what's being sold to their or offered to their participants.
Yeah, for sure. All right, the next case is one that's probably one of my favorites, Waldner versus Natixis Investment Managers. This was an interesting one. Natixis offered some of their own proprietary funds in their plan, and I think, does offering proprietary funds raise a bit of a red flag? Perhaps. But I think the responsibility of the fiduciary committee is to ensure that even though you're offering some proprietary products, that you're following the same fiduciary oversight that you would for any other investment offered in the plan. In other words, you're not looking at your proprietary products, which you are almost certainly making additional money off of relative to a non-proprietary product, making sure that you are not treating it any differently than anything else in the plan. And in this particular case, the plaintiffs are claiming that Natixis unfavorably utilized their own proprietary funds within the plan. And the reason I like this case so much is, a lot of these cases end up settling. We don't see a lot of them where we get an actual written decision based on the facts and the arguments of the parties involved. And This one was ruled in favor of Natixis. What was being challenged was the manner in which the fiduciary committee selected investment options, as well as the manner in which they oversaw the options once they were on the plan. So those were really the two sort of fact patterns that were reviewed. And in this case, Natixis had a very solid, not perfect, but very solid fiduciary process in place that allowed the judge to rule in their favor. And there were several things that the judge pointed to, which I think we can all learn from as absolute best practices for your fiduciary committee. First off, they had a set process for reviewing any potential fund option. It applied to all fund options, whether proprietary or non-proprietary. They had an independent investment advisor, and anytime they were looking at a fund to add or an asset class to add to the retirement plan, the independent investment advisor would give several comparable options that they could look at. The committee, through their minutes, it was clear that they reviewed and discussed the options before making decisions. And it is particularly important to note, 5 proprietary funds were added during the time period in question, but there were 2 additional funds that the investment advisor reviewed and provided information on that were not added. So you don't have a situation where every single time there's a proprietary fund that's being considered, it gets into the plan. And there was even a little portion of the case that I thought was interesting, which is sort of a throwing a bone for the Natixis Fiduciary Committee. It's okay to think that your product is the best in a given space. That's not necessarily a bad thing. So, it's okay to consider it, and if you believe it's the best product in that space, you can offer it. So once these products got into the plan, a similar process was used to monitor the funds. The committee received regular guidance from their ERISA counsel, did regular fiduciary training, reviewed the investment performance for all investments in the plan. The judge did find that the committee didn't always meet every quarter. They didn't quite do all the things that they necessarily said they could do. But this quote at the bottom, which is directly from the case, I think is great and very telling, which is Natixis need not prove the committee's greatness. Rather, the plaintiffs must prove their imprudence. So it's nice to include a case where you see after all the facts are laid out that the plan sponsor, the fiduciary, did exactly what they needed to do to protect themselves from a lawsuit like this. This is quite contrary from one of the cases that we included last year. United Health Group probably did almost everything wrong in that particular case. They ignored recommendations from United Health Group offered a suite of life cycle funds from Wells Fargo. And in the process of analyzing the use of those funds and retaining them, there were several items that lean towards against UHG. First, they ignored recommendations of their third-party advisor. In fact, when they made the final decision to keep the Wells Fargo funds, they didn't even invite their third-party advisor to the plan or to the meeting. There were strong business ties between UHG and Wells Fargo, really going both ways. UHG was the largest investor in the funds, and Wells Fargo was using UHG as the insurer for their employers. Perhaps most telling, though, there was a senior United Health Group executive who inserted himself onto the committee and helped influence the decision to retain those funds. And the one thing I left out is the independent investment advisor, out of 4 recommended investments, had rated the Wells Fargo product as the 4th out of all 4, yet it still stayed on the plan. This is obviously the opposite of the Natixis case. This is one where they did almost everything wrong. What we didn't report last year in the regulatory update, we knew UHG had settled. We didn't know the amount. It did turn out to be the largest ERISA settlement to date at $63 million. Of note, the plaintiff's attorneys filed to get a third of that and received $23 million in that case. The last couple I added here just to sort of make some points of some activity that's going on. David's going to talk a little bit about private equity. I included this Anderson versus Intel because while there has been a lot of talk in the recent months, probably about using alternative investments, using cryptocurrency, I think it's important to note that it wasn't prohibited. It hasn't been prohibited. And in this case, Intel actually back in 2008 created custom target date funds that had a sleeve of private equity investments in them. And in this case, the plaintiffs claimed that those were too risky and they were inappropriate. As it turns out, the judge ruled in favor of Intel, determining that Intel had done a very good job of educating participants on exactly what these investments were and what was in them. So, while there is a lot of talk about alternative investments, here you have Intel using private equity since 2008. This last one I included just to show sort of where we're at today with new litigation. We've had a lot of different types of cases filed, pretty much all of them now. We're just seeing them throw the whole quartet of fiduciary breach allegations in one bucket. They put them all in there, probably go through and see what'll stick. So the standard things that we're seeing in litigation today is claims of excessive record keeping fees, expensive managed account fees, underperforming or inappropriate stable value options, and of course, the use of forfeitures that we discussed earlier. So, this is sort of the typical blueprint that we're seeing for all the litigation. As far as it relates to litigation, we'll continue to keep track of everything that's going on and monitor these things and provide updates as new cases tell us more about our fiduciary best practices. So at the time left, I wanted to turn it over to David. Again, we can talk a little bit about there was an executive order that came out of the Trump administration that directed several government agencies to review their guidance and their processes regarding alternative assets with a goal probably to make them more accessible in defined contribution plans. David, you want to speak a little bit to sort of where we're at and your thoughts on private equity?
Sure. It feels kind of early in a I don't know. I'm watching some postseason baseball right now, so it feels a little early in a nine inning baseball game. But we are getting some guidance from the regulators that are looking to increase access. And so even before that executive order back in August, there's been noise from alternative investment managers. You're really trying to seek access to the kind of $13 trillion give or take defined contribution marketplace here in the U.S. And largely those assets have been really focused or the utilization has been in traditional public equities and public debt instruments with varying durations on the debt side, but it's largely been U.S. and non-U.S. equities in the public market and U.S. and non-U.S. debt. And so as private asset managers or alternative asset managers are trying to gain access to that, growing and primary savings vehicle here in the U.S., really looking to try and figure out how to gain access. The executive order seems to be supportive of uh, including alternative investments in the defined contribution marketplace. But I do think there are some, for lack of a better term, plumbing issues or operational issues associated with private equity in particular, but other non or alternative assets, private debt, private real estate, that have made those asset classes a little less attractive to both plan sponsors, but also defined contribution participants. And if I put on my way back hat and go back into the early and late 90s, you did see less daily valuation than today. But over the last 30 years, it's become not just an expected, but a requirement that I don't want to trade my funds every day, but I should be able to uh, liquidate my investments. I should be able to transfer on a daily basis. We do same day, late day trading. If I want to take a distribution, I can start that process whenever. I don't have to wait for a quarterly or monthly valuation cycle. And I think that's one of the issues that some of these alternatives face is they don't have daily valuation. Private equity is not marked to market on a daily basis. And so in order to gain the benefits, which I think, if you look at investment theory and some of the research, these investments benefit from some liquidity premiums associated with their lack of mark to market that allows management to take a longer term view to drive shareholder value, and that presents some opportunity on the upside. These investments historically, do have provided some opportunity for improve risk-adjusted returns, but there is some variation and dispersion in those returns, and that's been an area that, fortunately or unfortunately, I think, Greg, we spent a lot of time talking about risk mitigation and some of the litigation risk associated with these defined contribution plans. I think plan sponsors have been concerned about offering investments that produce returns that are significantly different than the general marketplace. I do think the wind has shifted. There's probably you're going to see an updated regulation and changes to kind of reporting requirements around these types of investments that make it maybe a bit more conducive for those types of investments. But you're probably not going to see them on a standalone basis, I guess would be my expectation up front. You may see them as part of a managed account portfolio or a component within a target date fund sleeve that is something where you're getting some of the benefit, but not exposing participants to quite as much of the liquidity and valuation risk associated with them.
Yeah, and actually, so I have a question here. Should a plan sponsor be concerned this will pop up as baked into current funds as a small percentage or part of a TDF series? And I think, in a perfect world, it would never pop up because your investment advisor is hopefully telling you what's in there. But I think that does speak to sort of what David's saying, which is how does private equity find its way to be offered inside of a defined contribution plan? It's probably as a sleeve or a small percentage of an otherwise managed account to help minimize, there's the four risks here. Two of them are particularly problematic for a defined contribution plan, which is the liquidity risk and the valuation risk, because of exactly what David said, which is these are valued daily, and private equity isn't necessarily valued daily, and it certainly isn't liquid. So I think those are some things that need to get worked out. Ultimately, though, when you think of private equity, I think what the plan sponsor is looking for is protection. Like I said, cryptocurrency and private equity, you can use it now. You can offer it in your plan if you find a product that can be in there. But most plan sponsors stay away from it because there isn't a safe harbor. And, in reality, the executive order didn't really change anything necessarily. All it said was agencies, why don't you go look at the way you monitor and oversee these types of investments. But short of a safe harbor, I think a lot of plan sponsors are still going to stay away. And at least right now in today's environment, I think an actual safe harbor for cryptocurrency and private equity currently does not seem to be in the cards, although anything could change quickly. So we will continue to monitor that. All right, so with 1 minute left, just real quick, some of the things we talked about today. Again, limited legislative and IRS activity. Most of it is relative back to Secure and Secure 2.0. The one agency that is taking some action is the DOL, already addressing their position on the fiduciary rule and the ESG rule, and the amicus briefs sort of showing that they are willing to step in and get involved with their opinion in litigation. As far as the litigation, I mentioned the lower pleading standards. Again, I look at litigation oftentimes to see what we can learn as plan sponsors, and I will continue to do that. going forward. And then, of course, the industry update. We will continue to monitor all the different types of products that are coming onto the marketplace, because there's definitely, to the extent that these products are rolled out, we want to make sure that you as a committee member, you don't have to add them to your plan, but I think we have a responsibility to educate you on what they are and what is available, and we'll continue to do that. So I'd like to thank everyone for your time today. We're right at time, exactly 1 hour. As always, if you have any questions, please feel free to reach out to either David or myself or your consultant. Thank you very much.
Take care, everyone.